what is one thing common in between all of these companies? All of them are predicated on one fact, which is that they were, when they started, going after a huge market, right? Stripe was going after global payments. Apple was going after global consumer electronics. Google ended up going after the global ad market. If you look at companies like Shopee in local players, they went after Southeast Asia e-commerce, big market. Then you would see Flipkart, went after India e-commerce. Udan, which is going after B2B e-commerce in India. The simple one message from this slide is, if you do not attack a big market, it's going to be hard to build a big business. It is not possible to build a big business unless you're attacking a big market. What is market size? Mathematically, simply put, the simplest definition of market size is number of customers that you can get multiplied by what the customers will pay you for your product or service. That is the simple mathematical definition. If you look at this chart on the right, there are two axes. The y-axis tells you the revenue per customer, and the x-axis is the number of customers that you can get. And depending on where you lie or where the product or service that you're building lies on this curve, this is known as the market curve. Let's call it the market curve. You can almost define what is the market size for, or what is the strategy that a company should follow to attack the market size. For example, in the case of enterprise, a classic enterprise sales motion, a company like CrowdStrike, a company like Medallia, and so on and so forth, you would see that revenue per customer potential, because they go after enterprise use cases, could be close to $500,000 to $1 million of annual contract. So naturally, they would have lower number of customers on the x-axis that they need to build a large business. For an SMB, for example, pick a company or a company targeting an SMB market segment. Pick an example. Let's call it Yelp. Let's call it Zomato, targeting restaurants, and so on and so forth. You would see that the annual revenue per customer would be smaller, but they would have larger customers available in the market to go after. Prosumer, likewise. Pick another example. I don't know, Peloton, for example. Commerce and marketplaces. You could pick a Flipkart, for example. The average ticket sizes are smaller, but the number of customers are larger or more. Consumer apps, pick a company like Facebook, pick Snap or any other, these companies, for example. Somewhere or the other, all the businesses would lie on this market curve, I'd say. How big is the market today? In terms of how to calculate market size, on the left-hand side, you would see that I refer to something called a top-down or a bottom-up calculation. This was something we picked up from the Airbnb original deck. You would see that they spoke about total addressable market. And in their case, they said total trips worldwide. And then they spoke about something called SOM. But that was a top-down or a bottom-up calculation that they used. The other way, very simplistically, for you to think about market size is you could use proxies, right? Like, for example, if you are building an e-commerce company, or if when Amazon was building an e-commerce company, it was quite obvious that they were going after the retail commerce market offline, right? And the retail was the backbone, is the backbone of the US economy, or for that matter, of any economy. And as a result, it is very natural that it is a big market. For some of these businesses which are creating markets, you have no option but to use proxies, right? For example, Uber was building in the mobility market, and the proxy they could take was offline taxi market in major cities. The first proxy they took was the New York market, the yellow cab. iPod sales, or when iPod market was being estimated, again, it was a new product, a new category, but one proxy that was available was how many people are using Walkmans, or how many Walkman devices are being sold per annum. So there is one, you could do some math, and that's the top-down, bottom-up calculation, or you otherwise could use proxies for some of the markets. Okay, TAM, SAM, SOM. TAM basically means the total market, which if you assumed all the people who would be potentially able to buy your product, what would that number of customers be? Multiply that with the number of, multiply that with the price they would be ready to pay for the product or service, right? This does not include competition. This does not include segmentation yet. It is just the universe of customers possible who could buy a product or service. It does not necessarily mean your product or service just yet. SAM, which is a segment of the TAM, means it is that subset of the TAM that now is about your product. It depends on your design choices. When we say design choices, it means your go-to-market choice, your feature set that you're offering in your product or service. If you multiply that, the number of users who would be willing to, depending on your product, would be willing to buy or use your product, and the money that they would be willing to pay, that you will get a serviceable addressable market. SOM is basically it is a portion or a subset, a further subset of SAM, which is, this includes somewhat, I would say, competition. This includes, what percentage of the market would you or your product be able to capture, accounting for all the competitive dynamics and so on and so forth. Do we use these methodologies on a daily basis? Actually, we don't, in the VC world, but it is good to know these and it is good to be aware of these. I think TAM, yes, is more frequently used. SAM and SOM are not as frequently used, I would say, but it is important in your product building journey, or in your product roadmap journey, because you may start with a SOM first, a certain segment, and then, as your product or service gets traction based on the go-to-market that you choose, or based on the sort of quality of your product, you will move up one notch and go into some of the other sort of, what the SAM, if you will, and then gradually you may want to get to TAM with expansion of the product. So it may be helpful from the context of designing the product and designing the go-to-market strategy still. The first slide would tell you, how do people calculate TAM? It could be a top-down approach or a bottom-up approach. Those are two mathematical approaches. And a top-down means nothing else, but it means that you're starting from something as big as, like, you pick a demographic, you pick an economic segmentation, you pick you use some geographical assumptions, and then you narrow down to a particular number, a smaller number, but you start with a big number first. That's what a top-down usually means. And most of these numbers, or many of these numbers, are available at in national sources or online sources. Be it, for example, the World Bank Group, or many regulators publish their own figures. For example, the Indian Authority, NPCA, publishes payments data in India. Similarly, Bank Indonesia and OJK publish Indonesia data on fintech and payments industry, and so on and so forth, some high level numbers, right? So top down means you start from top. We've taken an example, like, it's about, like, it's sizing the noodle market in Indonesia, for example. And we say you could start with a grocery market estimate. This is a big estimate. You would narrow it down to use some assumptions of, what percentage is dry foods, then what percentage is instant noodles of dry food and dry food, and then you would get to a market size. The second approach is the bottom-up approach. And this approach starts with a smaller number first, and then it gets to usually a big number. That's the way to think about a bottom-up approach. Small goes to big. And this starts with, something as simple as, let's say, if you use the instant noodle, same example, it starts with something as simple as the number of meals consumed by an individual in a day, or a week for that matter. That's 3 into 7. No points for guessing. 21. You could do this with some consumer surveys. People would prefer to do it if you survey 1,000 customers and ask them, hey, how many times do you have noodles in your meal? You would get some answer, and maybe that's the 5% answer here. Then you just simply multiply it by number of weeks in a year, average selling price, and then get to a market size for that product. Now, between top-down and bottom-up, which is a more reliable approach? I would say, VCs or investors do prefer a bottom-up approach. Let me take that liberty to say, for at least the markets that they know of, because it gives somewhat a more reasonable, rooted in reality number. And why I say rooted in reality is because usually the bottom-up approach borrows from consumer surveys and consumer interviews and insights on the ground, rather than depending on some national level data for that matter. So to the extent possible, try to do a bottom-up approach, even for yourself. If you're doing consumer interviews and consumer surveys, that has its own merits in helping you design the product. So I guess it goes without saying that should ideally form the basis of any product or any business you're starting. And naturally, if you're doing that very well for your product roadmap, this could help you with market sizing as well. Second question, in terms of sort of the key question, I'd say, is how fast is the market growing? If you have two examples, a big market not growing very fast, or a smaller market growing very fast, which one would you pick? Personal preference, and I would say many investors would say the same, would be you would pick maybe a small market today growing fast. And the reason for that is if it is a small market, you could be quite rest assured that many of the big companies would not be targeting it. It's not come on their radar. And hopefully by the time it comes on their radar, some of you would have built the product or service and get known for that category, right? The reason why growing fast matters is just some numbers for you here. 15 or 25% year-on-year growth rate means you could have a market, in 15x in 15 years. And 15 years is, trust me, not a long time period for, enduring companies to form. Hopefully some of you would be building it for longer than that. So going back, personal preference would be to pick a market which is growing fast compared to pick a big market which is growing slower. Simply the reason is that you would see in the market structure and market dynamics that the big companies would usually be after that big market already. And if they're not, that means there is something you are missing. Most likely, I'm not saying 100%, there's something you're missing that they see and are not going after. Well, is 25% really possible? Actually, yeah. There are many industries, many industries, electronic vehicles, renewable energy, blockchain tech, and applications, planet tech that are growing much faster than that, by the way. And fast forward 50 years, we will see enduring companies, very, very large companies in these industries. Is there a room to expand the market? Amazon, for example, started with e-commerce for books, right? And now today they are, naturally over time, natural evolution, they captured that. They went into concentric circles to reach or fulfill other demands of users. They went into general goods marketplace. Now they're in groceries. Now they're in video. They are also in computing services. AWS and so on and so forth. Gojek, nearer to us, started with mobility or booking, for your two-wheeler trips. Is now in financial services, is now in payments, is now in food delivery. Zilingo, again, closer to home, started with a B2C fashion e-commerce marketplace, is now a B2B fashion marketplace. Shopify, digital storefront, is now in, again, app ecosystem. It's in sort of payments, logistics, financing. I would say most successful companies, they start with something small, but if they are successful in that something relatively looking small, at that point they are able to expand the market and go into other execute very well in other segments as well. Would I prefer a smaller market right now potentially growing fast? Yes, because again, if you own a particular category or a market, you will have a lot of leverage to go and exploit other markets gradually. Either people will give you more money, or otherwise competitors will open up paths for you to try to own other parts of the markets. So fundamental questions, while thinking about market, I would say these three. What problem are you solving? What are the use cases of the product? And second, who are the target customers? If you imagine the market curve, the more you understand, and there is more nuance to the market curve than just saying enterprise, than just saying SMB. The more you understand the user, the better you will be able to understand their behaviors. And the better you understand their behaviors, the better you will be able to design a product, and therefore you'll be able to capture the market. And lastly, how will we monetize? Again, you don't have to have the ready, set, go answers in right away. In some industries, in some products, you should. But you should have some hypothesis. You should have some directions from the very beginning. You should not let it be on fate. On how we will monetize. I don't think VCs or investors are looking for concrete answers from the very beginning, but they are looking for directional answers, or they're looking for how you're thinking about it. Other fundamental question that as you're writing down some of these answers to some of these questions is, what is the number for you? Is it a 50 million number? Is it a 100 million number? Is it a $1 billion revenue company number, or even larger for that matter? What does a VC or an investor look for? Of course, they look for big numbers. The 100 million numbers used to be a coveted number a few years back, but now there are so many companies, double digit and growing, who have 100 million plus revenue in our markets in India and Southeast Asia. So the new bar, if you will, is becoming closer to $1 billion and more over time. That's something that we cover a lot of time in Surge also, with our companies, trying to help them think about, or trying to not help them think, but trying to at least ask this question so people can actively think about this, answers to this, or develop hypotheses on how they will get here.